Welcome to another episode of China Update, where I provide you guys with the most up-to-date political, economic and geostrategic analysis on the world's number 2 economy. My name is Tony. Let's jump in.
Okay, happy Wednesday everybody. Before we begin with the main developments, a small update from yesterday's video. After 2 weeks of absence, Beijing has finally confirmed that Foreign Minister Qin Gang is indeed experiencing health issues, without giving any further details. He was supposed to attend the ASEAN Foreign Ministers meeting to be held in Indonesia this week. Top diplomat, his boss, Wang Yi, will go in his place. This health issue does now appear to be the reason why Beijing last week abruptly cancelled Joseph Borrell's EU summit trip. First up with the main updates, we have more signs that more stimulus is on the way. Regular viewers understand the dynamics of China's slowdown and stalled recovery. We did a deep dive into deflationary fears and more stimulus calls yesterday. So for today, let's just take note of the newest developments on this front. Yesterday, Tuesday, state-run China Securities Journal, China's flagship securities newspaper, ran reports suggesting more property supportive policies and other measures to boost business confidence are on the way. The article said that the country is expected to, quote, accelerate policy rollout in order to promote the stable and healthy development of the real estate market, end quote. Meanwhile, also yesterday, the Institute of Finance of the Chinese Academy of Social Sciences published its China Macro Financial Analysis Q2 report, which was titled, Economic Weak Recovery, Policy Urgently Needs to Break Through. The report finds that since the second quarter, quote, multiple macro data have shown that the momentum of China's recovery growth has weakened and the problem of insufficient total demand is still prominent, end quote. The report urges a repair to balance sheets through, quote, increasing the intensity of counter-cyclical adjustments, opening the fiscal, monetary and real estate policy toolbox, end quote. We remember Nomura Research Institute chief economist Richard Koo, who first coined the term balance sheet recession, the idea that large levels of debt can weigh on future growth for many years in the future, recently warned that he sees a similar risk emerging in China. Yesterday, Koo appeared on the Bloomberg Odd Lots podcast in an episode titled China's Risk of Japanification. It's worth a listen to anyone interested in this topic. Our often quoted Professor Michael Pettis supplemented the episode with his own thoughts on the comments from Mr. Koo today. Quote, the best way to prevent the economy from slowing is not to spend a few more years borrowing and spending non-productively. It is to accelerate the rebalancing of the economy by transferring income from local governments who own a lot of assets to the household sector. This is easier said than done, of course, because it requires a massive transformation of political, business and financial institutions. But it's the only way we can avoid Japanification, end quote. Next up this week, yesterday and today, NATO is holding 2 days of meetings, and the bloc has already made it clear that China is as much a matter of focus as Russia. At a press conference yesterday, the NATO secretary told press, quote, China is increasingly challenging the rules-based international order, refusing to condemn Russia's war against Ukraine, threatening Taiwan, and carrying out substantial military build-up, end quote. NATO also published a communique highly critical of China, though without mentioning Taiwan by name. A few quick observations should be enough to get a taste of the communique's language. Article 6. The People's Republic of China stated ambitions and coercive policies challenge our interests, security and values. Article 23. The PRC employs a broad range of political, economic and military tools to increase its global footprint and project power, while remaining opaque about its strategy, intentions and military build-up. Article 24. We remain open to constructive engagement with the PRC, including to build reciprocal transparency, with a view to safeguarding the alliance's security interests. Article 25. The deepening strategic partnership between the PRC and Russia and their mutually reinforcing attempts to undercut the rules-based international order run counter to our values and interests. Article 55. The PRC is rapidly expanding and diversifying its nuclear arsenal with more warheads and a large number of sophisticated delivery systems to establish a nuclear triad, while failing to engage in meaningful transparency or good faith efforts to achieve nuclear arms control or risk reduction. Article 74. In the context of Russia's war of aggression against Ukraine, NATO-EU cooperation has become more significant and will also continue to address systemic challenges posed by the PRC to Euro-Atlantic security. Japan had hoped to announce a NATO liaison office in Tokyo. Back in June, Japan's foreign minister had called for the move, arguing that it was now a necessity after Russia's war in Ukraine. However, it appears that the French have blocked the move, with French President Emmanuel Macron telling reporters this week, quote, "NATO stands for North Atlantic," end quote. Of course, Beijing will not be happy with any of this. In a special editorial published today, state-run Global Times wrote, quote, "NATO must properly withdraw the black hand it has extended toward the Asia-Pacific region. Apart from certain countries like Japan, which act out of dark, selfish motives rather than considering the overall interests of Asia, the majority of countries in Asia not only do not welcome NATO, but also see it as a terrible monster that should be avoided at all costs. This is because NATO only brings security risks, war threats, and development predicament to Asia." End quote. Speaking of development predicaments, next up, the Chinese stock market. Hey everyone, if you enjoyed today's episode of China Update, don't forget to hit that like button. Liking, sharing, commenting, particularly sharing for people who you think might like this sort of content, is a massive help for the channel. For anyone who can go the extra mile and help keep China Update financially sustainable and primarily subscriber supported, Patreon and Buy Me a Coffee links are in the description below. As always, thank you so much, everybody, for the ongoing support. On Monday, we looked at international capital in Chinese equities. Today, we look at domestic money in the stock market. Several financial media outlets in reports this week warn that China's stock market is facing a wave of selling as money locked up in stock funds mature, which is the latest pressure point that adds a new set of concerns dragging on sentiment. According to data compiled by Morningstar Inc., more than 200 billion yuan, $28 billion of cash that's been stuck in mutual funds over the past 3 years is about to be freed up. And with the current market sentiment, this will likely be taken away from equities. Indeed, back in June, Shanghai Banxia Investment Management, one of China's biggest hedge funds, warned in a client's note that, quote, "net outflows from 3-year mutual and private funds will be inevitable," end quote, further putting downward pressure on stock prices. US financial media outlet Bloomberg writes that some 38 stock-related funds launched in 2020 with a 3-year lockup averaged a 0.4% loss since inception as of the 31st of May, with less than half of them posting a gain. The 13 funds set up in 2021, the outlet continues, with a 2-year lockup were all unprofitable, with an average loss of 13%. The 185 products with a 1-year lockup expiring this year are down 3.3%. Quote, "It's a sea change from 3 years ago when money flowed into stock mutual funds in China. Back then, fund houses touted the benefits of longer holding periods with confidence. But now, investor patience is certainly facing a big test. Investors are suffering from an expectation gap, from the fact they still can't make money after sacrificing years of liquidity." End quote. Okay, that is today's episode of China Update. Thank you so much everybody for watching. Have a wonderful Wednesday, and I will see you all tomorrow.